Hello, and welcome to another episode of Coffee with Caprell. See, even says coffee, but there's no coffee in the cup. It's 10 after 12. I've had my share. I'm all good. Hey, I wanted to talk to you a little bit about taxes and how it works when you have a mutual fund portfolio. Now, this may be a little bit more technical than you want to get into, and that's fine. That's fine. But I always feel like I have an obligation as well as a desire to keep you informed and educated. All right. So when you have an IRA account, if you haven't taken any withdrawals from the IRA account, you're not going to get any 1099. Same would be for a Roth IRA. In fact, Roth IRAs, you might get a 1099, but it's probably going to indicate that it's not taxable. But when you have an IRA, dividends and interest and all that don't show up on your 1099. The only thing that shows up in your 1099 is withdrawals. So if you made a withdrawal, you're going to get it. And chances are 100% of that money is subjected to taxation. It's when you have an account that's not part of an IRA that gets a little tricky. So let's say you have an investment account and it's jointly owned between you and your spouse or individually owned by you. In that instance, then, you're going to get a 1099 that's going to be longer and with a lot more details. The first thing the 1099 is going to indicate is how much interest and dividends did you receive that year. Now, in your mutual funds, you own companies, and companies will pay out dividends throughout the year. You may even have some money in bonds, bond mutual funds, and those are going to pay out interest. Then you have two types of capital gains. There's the kind of capital gain that occurs when the portfolio manager, us or the subsidiaries that we work with, rebalance your portfolio. If you call us for money, something has to be sold and then everything has to be rebalanced. That will trigger taxation. The other one is the capital gains that are distributed by the mutual funds themselves. Within the mutual fund, there's constant rebalancing going on. And as a result, that is going to generate a capital gain within the fund. So even though you didn't pull any money out, the fund did some internal rebalancing, and that generates taxation. And that's the hard one to predict because most of the time that's not done until the end of the year. The other one, typically quarterly, is when we look to rebalance, all right? So there's a lot of nuances there, and I know sometimes people are like, this makes no sense. I took no money out. Why do I have capital gains? Well, we rebalanced, as well as the companies that are owned by the funds might have done some internal rebalancing as well, and that's what's going to generate that activity. But keep in mind, capital gains do get taxed at a lower level for most people than their income tax rate, so it's not all that bad. Given the choice, I'd rather take the capital gain here, all right? So if you have any questions on that, feel free to give me a call, but every once in a while I get into a deep discussion with someone on how it works, and I want to make sure that everybody's clear. All right? You have a great day. Bye-bye.